Hi everybody, Alex Explorer here from Expert Forex, and in today's video we're going to be looking at an incredibly important concept. We're going to look at a millionaire trader that shares his lot sizing strategies, and this is critical information for anybody who ever traded or will trade a prop firm account. You cannot trade a prop firm account without the knowledge that you are going to see in this video. So a lot of the information here comes from my trading partner, Barry Thornton, who contributed to Expert Forex quite early in its life, wrote a lot of trading material that is still available in our free forum. So what I'm showing you here is not a theoretical idea, it is actually something that has been put into practice and is producing the results that have been mentioned. 5 days ago I created this video, Create Financial Freedom and Retire in 24 Months, and it details the importance of monthly returns and how you can compound those to retire in 24 months or be, let's say, financially stable in 24 months. I suggest you watch this video because it goes hand in hand with what I'm going to be showing you pretty soon. Okay, for this video I'm going to use some examples created by our hedged trading robots. These are actual trading results that have been achieved, so they are not back traded or any theoretical results, they are actual traded results. And on the marketing page we actually give you a whole lot of settings and the results of all of those settings over there. So what I've done is I've taken this table and I've extracted 6 accounts that have more or less the same profitability. So let's go and have a look at those 6 accounts. So here they are. It's number 1, 4, 6, 21, 29 and 39, and why I selected these accounts is the statistics that come out of these trading accounts. And here you can see the first item we look at is the maximum drawdown. So there's a list of maximum drawdown statistics, and then we look at the closed gains. So those are the actual profits made that have been capitalized into the account, and again you can see there. But here comes the most important ratio, and this is a ratio that I've discussed in previous videos, which is the return on drawdown. So what your maximum drawdown represents is your risk that you're taking when trading the strategy, and what your closed gains represent is the return on that risk that you're taking. And then we can create a ratio which says how big is the gains compared to the risk, and the return on risk ratio is exactly that. And that is why I selected these 6 accounts. They more or less in the same area. So they've got 360, 320, 320, 350, 360, 340. So they're more or less the same. So their return on drawdown is more or less the same. But the drawdown as a percentage of the investment is quite different. It varies from 6% right down to 14%. So it shows you some strategies have bigger drawdowns and other ones have smaller drawdowns. And then the return on investment, which is really the $10,000 that these accounts started with, is basically the gains made over the $10,000 started with. So you have returns varying from 23% right down to 48%. Okay, so let's say we have 3 types of investors. Firstly, you have the conservative investor that wants a maximum drawdown of 5%. Then you have a balanced investor that doesn't want to exceed 10% drawdown. And then you have the more aggressive investor that says, look, I don't want to be constrained by the drawdown. I'm happy with a 20% drawdown as long as the income is proportionately better than the lower drawdown one. So we have 3 different profiles of investors. In fact, that is exactly what happens. The prop trading investors are generally in this area. They don't want a drawdown bigger than 5%, and then the more aggressive traders are not too worried about a 20% drawdown. And then you have the balanced ones that say, look, if I can get a 10% drawdown, I'm happy to take the risk. So let's have a look at that list of possible investments. And here they are. Now, just looking at them, you would say, okay, the aggressive investor would never look at this one that's only got a 6% in risk profile, and the conservative investor will not be able to invest in any, because all of them are above the 5% threshold that this investor has. So basically we're saying, and then there's not even one that has a 20% risk, so the aggressive investor can't fully get the returns they want by having extra risk. Now what I'm going to be showing you in this video is that any of those three investors can invest in any 6 of these accounts if they adjust their lot sizing. So these results were created with those lot sizes you can see over there. So this makes it very easy for investors to look at this investment and say, look, I can convert this investment to the profile that I am looking for. And that is one of the skills that top investors have. They can take any investor and adjust it for their particular portfolio. And I'm going to show you how they do it, and I'm going to show you how Barry Thornton has generated over $1 million of income every year since the last, I think, 15 years using this risk control mechanism. So let's have a look how it works. So let's say we have a conservative investor, and that conservative investor wants to invest in account 39. So let's go and have a look at account 39. There's account 39. It has a drawdown of 14%, but the investor only wants a drawdown of 5%. So it actually is very, very easy. All they have to do is reduce the lots traded by the proportion that 5% has to 14%. So let's go and look at how that is done. So account 39 has a drawdown of 14% when trading 0.1 lots. So to reduce the drawdown to 5%, you would use this formula, and the formula is very, very simple. It says, what is the drawdown you want? Divide that by the actual drawdown percentage and then multiply it by the lots used. So that's very easy. You want 5%, the actual drawdown is 14%, and then you times it by 0.01. Now, when you do the sum, and you can do it on a calculator, very easy, you take 5, divide by 14 times 0.1, and you get 0.36 lots. Now, you can't trade 0.036 lots, so you've got to round it up to 0.04 lots. So there, we've done it. We've done this simple exercise. Now a conservative trader can actually make use of an account that's being traded relatively aggressively with higher returns, but they can convert that account to the risk profile that they want. So if a conservative trader copies account 39 using 0.04, not the 0.1 that's originally traded, but the 0.4 lots, it is likely that the maximum drawdown will be 5%. Now again, that's based on historic performance, and historic performance can change over time, and that's why you have to update your historic performance regularly, and also use historic performance that has a really good track record. 1 week is not enough as a track record. You need a couple of weeks of track record to do that, and the longer the better. But that is the formula you use. That is how a conservative investor can invest in any of those accounts that we saw earlier. So there we are. So the conservative, so what I've done is I've actually calculated that formula for all the investors. So if you're a 5% investor, you have to adjust your lot sizing to those values, and then the drawdown number, that drawdown number is likely to stay below 5%, which is $500. If you are a balanced investor, those are the lot sizings that you would use to keep your drawdown at roughly $1,000. Now notice sometimes the lot sizing is actually bigger. So this is being traded at 0.05. The balanced investor can actually increase their lot sizing because that is actually too low. It's only at 6%. They're happy with 10%. They can increase their lot sizing. And then the aggressive investor can do the same thing. This investor is happy with a 20% drawdown. You just adjust the lot sizing proportionate to the actual maximum drawdown that's occurred, and you can then trade any of these accounts. So any of these investors can trade any of these accounts if they do that little simple sum that I've shown you before. So let's go on and have a look at that. So we now have an aggressive investor that wants to invest in account 1. Now account 1 is not the greatest performer in that the drawdown has only $600. The income is quite nice. Just remember why I'm using these 6 accounts is that they more or less have the same profitability. They have the same return on drawdown. That's why it's I can use these 6 accounts. So the drawdown is only that, which is only 6%, and the aggressive investor wants to expose themselves to 20% drawdown, and you can see there isn't a 20% here. So let's go and see what the investor does. Account 1 has a drawdown of 6% and has been trading 0.05 lots. So to increase the drawdown to 20%, you would use the formula again. Desired drawdown divided by the actual drawdown times the lots used. 20% is what's desired. 6% is what is happening at the moment, and the lots times the lots is that, and then you get a number 166. Again, you have to round that off because brokers only allow lots up to 2 decimals, and 1.7 would be the lots. So if you're an aggressive investor and you copied account 1 using 0.17 lots and not the 0.05 lots, then your maximum drawdown is likely to be plus minus 20%. So again, the point of all of this, and I'm repeating this over and over again because it is very important and critical to prop trading, to linked account trading, to your own trading, you have to match your risk exposure to your lot sizing. It's critical. It's the most fundamental thing that has made Barry Thornton the millionaire that he is. And then let's have a quick look at the balanced investor that invests in account 4. Now, so let's look at account 4. Account 4 has a return of a drawdown of 13%. The investor is looking for a return of looking for a drawdown of 10% at the most. So clearly that lot sizing is too big and they have to reduce it. So again, the calculation is 0.08, and let's go and have a look at how that calculation worked out. So we're looking at account 4, which is a drawdown of 14% when traded on that. So to reduce the drawdown to 10%, you would use that formula, which is the drawdown percentage desired, the actual drawdown percentage, and then the lots used, which is 10% is what the investor wants, then 13%, which is the actual drawdown, times the 0.01, and there you get it, 0.0769 lots rounded to 0.08 lots. So again, the conclusion is if the balanced investor copied the account 2 using 0.08 lots, then the likely maximum drawdown would be 10%. Now that's how you can adjust any strategy that you're using to meet your risk profile. And that's what I've done here. And as you can see, you're basically calculating the drawdown to be in the area that you want it to be. And there are the lot sizing, and that's if you recalculate the drawdowns, that's what it works out to. So now I'm not one that is fond of trading rules because I find them restricting. And certainly when it comes to actual trading, the rules can actually hold traders back quite badly. But here are two rules that are fundamentally important for millionaire traders, so they should also be fundamentally important to beginner traders, because they have to apply these rules. You should only invest in strategies that produce more than 300% return on risk. Now, what happens is that when your strategy starts out, it won't give a return of 300% on risk. You might have to trade it for a month or two or three months. But sooner or later, if you are using a good strategy, you will start getting that ratio to come to 300% on risk. And then only can you trade those strategies. So very important, don't just dive into a strategy that is untested, has no track record, and then go and invest in a prop firm account with nothing behind you. You have to have a proven strategy with proven ratios. Then rule number 2 is you must align your lot sizing with the maximum risk you anticipate, taking your risk profile into account. Now, if you do that and you're a prop trader, you will never need equity protection, or you will never sweat, because you have done your calculations, you've got the right lot sizing. And what I would do is, if you get the lot sizing per the calculation, I would even reduce it to 80% of that answer. So you reduce the lot sizing to a point where you sleep soundly. You don't need equity protection, you don't need anything else. You know that you're going to get your 300% return, and your maximum risk is less exposed. Now, always remember, you're always basing these calculations on historic figures, so you have to firstly update your figures regularly, and secondly, they do not guarantee that what happened in the past will happen to the future. But these are guidelines, and very important guidelines, where you have to align your lot sizing with the maximum risk you anticipate. And again, I'm repeating this over and over again, because I can't tell you how important this is. All of our blown accounts, all of them, 100% of them, are because traders have not aligned their lot sizing with the maximum risk that they were anticipating. It is the major cause of blown accounts. If you have another cause, please let me know. If you have identified a 300% return, you've aligned it, and you've still blown your account, please let me know. That would be highly exceptional. So now that you have this knowledge, where do you find accounts, firstly, that have a 300% return on risk? Now, here's our link to success service. We have over 100 accounts. They are all profitable accounts, but they don't all have the 300% return on risk. You have to find the ones that have, and you can start with the most profitable ones over here and just go through them. So you would look at how much profit was generated, because they all started with a particular lot sizing, and then you would find the maximum risk, which I have shown you in a comprehensive video earlier, to how to find the maximum drawdown that has occurred, and then you'll do that sum, and you'll decide, oh, this is an account that I can link to firstly, but also this is an account that is a possible prop firm account. So you can start looking at our linked service. Our linked service has a mixture of robots. You can see the Liberator, the RSI Liberator, the Wave Liberator, the Hedged Liberator, the Profit Retriever, and so on and so on. Those are our best EAs. They generate this 300% ratio consistently, and especially over a period of 2 to 4 months. So you can't expect us to generate that very early, but certainly over a longer period. And you can see some of these accounts, the average age of these accounts is 281 days. So you'll find some really established track records that you can rely on. And here are those 4 accounts, the 4 robots that we have. A lot of traders have looked at our linking server and said, hey, I can actually do better because we actually supply the linking server settings, not all of them, most of them, either into our paid forum or into our free forum. And you've actually seen, I've already shown you that those settings are available for the hedged EA on the market page. So we actually give you those settings on the market page. You have all the information you want. You have the accounts that are generating the 300% returns, and all you need to do is make a decision on which ones are the best ones to invest in, or which EAs you want to trade on your own. And if you want to trade them, and here's a very special bundle that we've created recently of the 4 robots that are generating these fantastic returns. Now, I hope you've enjoyed this video, and I hope that you've realized the importance of aligning your lot sizing with your risk profile and with the historic information from the robot that you intend trading or from the linking service that you want to link to. I get very emotional about this particular principle because it is the prime reason why Forex traders fail, because they do not align their lot sizing with their risk exposure and with their risk profile, whether they're aggressive or conservative or balanced. If you haven't fully understood this principle, please watch this video over and over again and use more your own examples. You go to the link service and grab a few of those accounts and analyze them out, see what kind of risk return ratios the accounts have. Do a lot of practice on this, because once you have this one mastered, luckily Barry Thornton got this mastered in the first year of trading. This was his principles that he used in the very first year of trading, and that was at the turn of the century. So he has had over 23 or 24 years of successful trading because of that. So as always, links to items mentioned in this video will be in the description of the video as well as in the commentary of the video. So from me, Alex Deploy, cheerio.